The Ministry of Transport has expressed its disappointment due to the shutdown of the Kelana Jaya LRT Line for 7 days starting today. MOT has asked the LRT's owner-operator Prasarana Malaysia to update the public periodically to provide information. Caretaker Transport Minister Datuk Sri Wee Ka Siong says he was very disappointed, felt sorry and apologised to the public for the inconvenience caused by the shutdown of the Kelana Jaya line. Although Prasarana sits under the Ministry of Finance and not the MOT, Wee says that as the regulator of the transport industry, his ministry must ensure that the safety of the users comes first. Wee says Prasarana has been trying to identify the source of the problem that caused the breakdown in the signalling and contact system that could not identify where the trains are. He adds that this is very dangerous as the failure of the system could result in train collisions if the LRT continues to be allowed to operate. Wee says experts from Istanbul and Toronto and Thales, the technology owner of the automatic train control system, are being flown in. To recap, Rapid KL has shut down 16 stations along the Kelana Jaya line for a week, a decision it had made after the stations were shut down on Tuesday when an ATC system malfunction was detected. Earlier today, Prasarana President and Group CEO Muhammad Azharuddin Matsa acknowledged that the system had reached the end of its lifespan, adding that the sum of 150 million for the first phase of upgrades had already been approved. He points out that the Kelana Jaya line has been in operation for nearly 25 years. Muhammad Azharuddin elaborates that the group is preparing to add new trains in July 2023. CapitaLand Malaysia Trust is buying 91.8% of the total strata floor area of retail parcels in Penang's Queensbay Mall from parties related to CapitaLand investment for 990.5 million in a related party transaction. A private placement will be undertaken to fund the acquisition, which entails the issuance of new CLMT units to raise gross proceeds of up to 50% of the total purchase consideration. The issue price will be determined later by way of a book building process. In support of CLMT, CLI says it is committed to supporting the proposed private placement and intends to take up its pro rata entitlement included as part of the funding for CLMT to acquire the property. As at November 3rd, CLI has a deemed interest of approximately 39.3% in CLMT. Taking into account the acquisition fees and expenses, the total acquisition cost is approximately 1.03 billion ringgit and will be funded by a combination of bank borrowings and proceeds from the proposed private placement. CapitaLand Malaysia REIT Management CEO Tan Choon Siang said that this proposed acquisition, the largest since its listing, will add meaningful scale to CLMT and deepen its presence in Penang. Tan says post-acquisition of Queensbay Mall as well as of a logistics property in Sungai Jawi, CLMT will have 7 properties in its enlarged portfolio with an uplift of 28.2% in assets under management to 4.9 billion and an increase of 39.7% in net lettable area to approximately 4.3 million square feet. Queensbay Mall is one of the largest shopping malls in Penang with a committed occupancy rate of 95% as at October and receives an average of 1.1 million shoppers per month, with traffic set to improve further once tourists fully return. The acquisition is conditional upon approval from CLMT's non-interested unit holders at an EGM to be convened at a later date. It is expected to be completed by the first quarter of 2023. Fraser and Eve Holdings aims to raise up to 800 million in capital expenditure for FY23, with most of the funds earmarked for its dairy farm business. At a press conference, CEO Lim Yu Ho said this is more than 3 to 4 times than what the group has invested so far. As a comparison, in FY22, FNN invested about 190 million ringgit. However, Lim did not disclose a detailed breakdown of the capex. He goes on to say that the F&B giant has completed the acquisition of agricultural land, Ladang Permai in Gemas Negeri Sembilan, for 215.6 million ringgit. As such, the group is on track to resume its plans for the upstream fresh milk business for downstream production and distribution of fresh milk. Lim says this move will allow it to be less dependent on imported milk and promote the local agriculture industry. In addition, Lim says the group could face increasing competition in the dairy space from other Bursa-listed companies such as FGV Holdings, Dutch Lady Milk Industries and Farm Fresh. However, he says there will be no most severe overcapacity in Malaysia amid growing demand for fresh milk in the region. Meanwhile, FNN expects its export margin to normalise in the first half of 2023, according to its Director of Group Finance, Tiong Yen Yao. Tiong says that FNN is currently trying to maintain the prices of its products and have no plans to increase it. For FY22, FNN's net profit fell 3% year-on-year to 383.2 million, despite revenue improving by 8.2% to 4.47 billion ringgit. Duo Pharma Biotech's third quarter net profit slipped by 3.6% to 16.35 million from the 16.96 million it posted a year earlier, pressured by higher finance and operating costs. In contrast, revenue improved by 3.1% year-on-year to 177.07 million. Duo Pharma said its bottom line was pressed by finance costs, rising 97.7% to 3.7 million, and operating costs climbing 10.3% to 47.46 million ringgit. In light of the strong demand from the private ethical market and public health sector, Duo Pharma Group MD Leonard Arif Abdul Shatta expressed optimism for a satisfactory performance in FY22. He notes this is further underpinned by a positive growth momentum in Malaysia's economy following the reopening of international borders, despite manufacturing margin pressure from the strong US dollar. In a statement, he said that Duo Pharma will continue to explore new opportunities to expand its product portfolio in the health and wellness sector as a leading pharmaceutical company in Malaysia and strengthen its commitment to the halal sector. Perusahaan Automobile Nasional is in the midst of strengthening its EV capabilities and plans to launch and produce its own EV by 2027, says Deputy CEO Ruslan Abdullah. Ruslan says Proton had been discussing with potential partners to embark on the venture, as it could not just jump into producing EVs without understanding how to sell and market the vehicles. He says Proton's EV roadmap started 10 years ago, but it was not pursued due to low market demand and technologies. Ruslan explains that the next 5 years will give Proton ample time to determine which technology is the most acceptable, easy to maintain and affordable for consumers and the car maker. Before having its own EV, Ruslan says Proton would gain more experience by collaborating with Smart Automobile as the latter's distributor in Malaysia and Thailand. Smart Automobile is a JV established by Mercedes-Benz AG and Zhejiang Geely Holding Group. When asked about the challenges new energy vehicles face in penetrating the Malaysian market, Ruslan says the solutions require strong support from the government, better industry readiness, and a shift in customer preference towards EVs. He said sales of NEVs had increased to 3.4% of 13,800 units year to date, with hybrid EVs being more popular than battery-powered EVs.